Welcome to Market Brief After Hours. Today, we are unpacking a highly reactive trading session. The overarching theme seems to be a fragile equilibrium, where solid economic fundamentals are being entirely overshadowed by geopolitical tensions.
That is exactly the dynamic at play right now. We are seeing a market that is fundamentally sound but sentimentally fragile. The approaching US-Iran ceasefire deadline, even with the later extension by President Trump, cast a very long shadow over the trading day. Investors simply turned cautious, and that risk-off tone dictated the flow of capital across almost every asset class. It is a classic scenario where headline uncertainty takes the wheel, pushing actual economic data into the passenger seat.
Let's look at how that played out on Wall Street. The major indices all took a hit, pulling back from some very strong recent performances.
They certainly did. The Dow Jones Industrial Average fell 0.59% to close at 49,149. Early gains just completely faded as the session wore on. The S&P 500 declined 0.63% to finish at 7,064. That is a notable retreat, especially considering the index recently closed above the 7,100 milestone for the very first time. And then we have the Nasdaq Composite, which dropped 0.59% to 24,260.
That drop in the Nasdaq is particularly interesting because it snaps a historic run, doesn't it?
It really does. The Nasdaq just ended its longest winning streak since 1992. Technology stocks had been the engine of this massive rally, but momentum cooled off significantly today as risk appetite weakened. Even with expectations of double-digit earnings growth and strong revenues across the broader market, investors just couldn't maintain that upward trajectory.
And it wasn't just geopolitics weighing on U.S. markets. We also had some retail sales data that looked great on the surface, but maybe told a different story underneath.
Precisely. U.S. retail sales jumped 1.7% in March, which was well above expectations. But when you dig into the numbers, that headline figure was heavily flattered by inflation. There was a massive 15.5% surge in receipts at gas stations because prices at the pump have risen so sharply. Now, excluding autos, sales still increased 1.9% and the control group rose 0.7%, which points to solid underlying consumption. But those higher fuel costs are reinforcing concerns about persistent inflation. We also saw pending home sales rise 1.5% in March, beating the 0.5% forecast, despite mortgage rates climbing to 6.38%. It shows resilience, but tighter financial conditions are clearly constraining the housing market.
Let's cross the Atlantic. European markets seem to mirror that same cautious sentiment.
They did. The Pan-European Stoxx 600 index reversed its early gains to close 0.87% lower. Looking at the specific countries, the FTSE 100 in London dropped 1%, while the CAC 40 in Paris fell 1.14% to 8,236 points. In Frankfurt, Germany's DAX 40 mirrored its peers with a 0.6% decline, closing at 24,271.
Was there any domestic economic data out of Europe adding to that downward pressure?
Yes, economic data definitely added to the gloom. Germany's ZEW indicator of economic sentiment plummeted to negative 17.2 in April. That is a huge miss compared to the negative 5 that was expected. Elsewhere in the region, Switzerland reported a narrow trade surplus of 2.7 billion Swiss francs, though Poland actually saw a bright spot with industrial output surging by 9.4%. But overall, Europe remains incredibly sensitive to energy price fluctuations and these broader geopolitical developments.
Speaking of the UK, the FTSE 100 extended its decline despite some surprisingly resilient domestic labor data. Let's break down those employment numbers.
The UK labour market is actually showing remarkable firmness. The unemployment rate fell to 4.9% in the 3 months to February. That beat expectations of 5.2% and is the lowest level we've seen since last summer. Total unemployment dropped by 60,000 to 1.78 million, and employment actually rose by 24,000, pushing the employment rate up to 75%.
But what about wages? That has been the major inflation sticking point for central banks. That is where we saw some cooling, which central bankers will likely welcome. Total average weekly earnings rose 3.8% year-on-year. That is down from 4.1% previously, though still slightly above the 3.6% forecast. Private sector pay growth slowed to 3.5%, and public sector earnings moderated to 5.2%. When you adjust for inflation, real wage growth increased by just 0.4%. So you have a strong jobs market, but easing wage pressures. Usually that would be a Goldilocks scenario for equities, but today it offered virtually no support because global geopolitical fears were just too loud.
That is where we saw some cooling, which central bankers will likely welcome. Total average weekly earnings rose 3.8% year-on-year. That is down from 4.1% previously, though still slightly above the 3.6% forecast. Private sector pay growth slowed to 3.5%, and public sector earnings moderated to 5.2%. When you adjust for inflation, real wage growth increased by just 0.4%. So you have a strong jobs market, but easing wage pressures. Usually that would be a Goldilocks scenario for equities, but today it offered virtually no support because global geopolitical fears were just too loud.
And commodities? With the Middle East tensions, I imagine energy markets were highly reactive.
Highly reactive is the perfect way to describe it. Crude oil prices climbed sharply. Brent rose 3% to $98.48 per barrel, and US crude advanced nearly 3% to $92.13. Doubts over the US-Iran peace talks immediately bring supply disruption risks back to the forefront. If tensions persist, energy markets are going to remain incredibly tight. We also saw Bitcoin slip from near 77,000 down to around 75,000. Crypto-linked equities took a beating too, with Coinbase falling more than 7%. The Fear and Greed Index rose to 33, but that still keeps sentiment firmly in fear territory.
We are going to take a quick break. When we come back, we will dive deep into the currency markets, check the technical levels on precious metals, and look at today's biggest single stock movers. Stay with us. Welcome back to Market Brief, After Hours. Let's get right into Forex. The currency market saw some significant technical movements today. Let's start with the euro against the dollar.
Euro USD had a tough session. It closed at 1.1725, which is down 0.53%. During the day, it traded between a high of 1.1791 and a low of 1.1719. What we are seeing technically is a rotation lower after the price was rejected near the 1.1850 region. This latest move brings the price right back toward a critical support level, the 100-day moving average, which currently sits at 1.1704.
And if it breaks below that 100-day average, where is the next floor?
If it falls through 1.1704, there is a very dense support cluster just below it. You have the 50-day average at 1.1666 and the 200-day average at 1.1674. That zone will be closely watched by traders. On the flip side, immediate resistance is at today's high of 1.1791, followed by that swing high near 1.1850.
The British pound also seemed to struggle against the greenback today. It did. GBP USD closed at 1.3479, down 0.40%. It traded between 1.3539 down to 1.3474. It has been easing back ever since it failed to hold above the 1.3600 handle. Similar to the euro, the pound is drifting closer to a key cluster of moving averages. The 100-day average is at 1.3452. Just below that, the 50-day average at 1.3419 and the 200-day average at 1.3413 reinforce a very strong technical floor. If we see a break below 1.3413, that would signal a much deeper corrective move, potentially all the way down toward the 1.3200 region. Let's look at the Japanese yen. USD JPY continues to push higher. What are the technicals telling us there?
The trend here is very well established. USD JPY closed at 159.60, up 0.50% for the session. It traded between 158.71 and 159.63. The price is holding firmly above all its major moving averages. The 50-day is at 157.73, the 100-day is at 156.99, and the 200-day is way down at 153.55. Because it's holding so strong, all eyes are on the 160.00 psychological level. That is the key barrier. If the bulls can break above 160.00, it opens the path to fresh highs.
Moving over to precious metals, it was a brutal day for gold and silver. Selling pressure really intensified.
Brutal is the right word. Gold closed at 4,680, tumbling 2.94%. It traded between 4,668 and 4,833.
That sharp decline pushed the price below two major short-term indicators, the 50-day moving average at 4,888 and the 100-day at 4,712. That signals a definite shift in short-term momentum. However, the longer-term trend remains intact because gold is still well above its 200-day average, which sits at 4,204. Immediate support rests at today's low of 4,668, followed by the 4,500 level.
And silver mirrored that drop, but even more aggressively?
Yes, silver slid sharply, closing at $75.72, which is a massive 5.02% drop. It traded between $75.51 and $80.19. Just like gold, it broke decisively below its 50-day average at $78.93 and its 100-day average at $77.78. It is still above the 200-day average at $60.67, but losing that near-term support suggests we are entering a deeper corrective phase. If selling pressure persists, we could see further downside risk toward the $70 level.
Before we wrap up, let's pivot to individual market movers. There were some massive swings in single stocks today, starting with Avis Budget Group.
Avis was the wild one today. Shares soared 17%. This wasn't necessarily driven by a fundamental change in their business overnight. It was a classic short squeeze. The stock had very high short interest and highly concentrated ownership. When the price started moving up, short sellers were forced to buy back shares to cover their positions, which just poured gasoline on the rally.
On the other end of the spectrum, Tractor Supply had a rough session.
Very rough. Tractor Supply slid 11%. They released their first quarter numbers, and both earnings and revenue figures failed to meet analyst expectations. In this kind of cautious market environment, investors are severely punishing any company that misses the mark.
We also saw some turbulence in the aerospace and airline sectors, with GE Aerospace and Alaska Air Group.
GE Aerospace fell 6%. They actually reported a positive quarterly earnings report, but they lowered their flight departure forecast. The market completely ignored the good earnings and focused entirely on that downward revision in the outlook. Similarly, Alaska Air Group dropped 5%. They reported a wider-than-expected quarterly loss, but the real damage came from them withdrawing their 2026 financial targets entirely, citing volatility in fuel costs.
It all comes back to that theme of uncertainty, whether it is fuel costs for airlines, geopolitical tensions in the Middle East, or shifting central bank policies. Markets are highly reactive right now.
Exactly. The divergence between strong macroeconomic signals, like the US consumption data or the UK employment numbers, and the cautious positioning we are seeing in the charts highlights just how fragile the current equilibrium is. Confidence can shift on a single headline.
We will certainly be keeping a close watch on those headlines and technical levels as the week progresses. If you find this useful, please follow Market Brief after hours.